Hello, my name is Jingonelli and I'm going to be taking you through another part of partnership. But before I begin off, I'm going to require you to subscribe. It will bring you some good luck in your forthcoming exams, and also follow what I'm pointing at for you to be able to follow up properly. So today I'm going to be handling revaluation of assets and liabilities. Now with this, you have a revaluation of assets or liabilities is important when a new partner is admitted, dies or retires. So non-current assets like machinery and buildings have to be revalued because their market value at the date of change in partnership may be greater than their cost. Note that it may be greater than their cost. And moving on, the difference between the current market values of those assets and their book values is shared among the partners in their profit and loss sharing ratios. So a revaluation account is open to ascertain whether there is a gain or a loss on revaluation. So a loss on revaluation will be debited on the partner's capital account, while a gain on revaluation will be credited on the partner's capital account. Now with this, a loss, this is an illustration on the partner's capital account. I'll go on the debit side and I'll put there revaluation loss, and I put there the figures. And if it is a gain, I'll go on the credit side of the partner's capital account, and I'll put there revaluation profit, and I put there the figures. So moving on, I'm having an example. So with this example, it is saying Abdul and Sarah are partners sharing profits and losses in their ratio of 1:4 and 3:4 respectively. On 31st December 2020, their balance sheet was as follows. So I'm having Abdul and Sarah's balance sheet as 31st December 2020. I'm having non-current assets whereby premises is 50,000, furniture is 40,000, motor vehicle is 20,000, fixtures and fittings is 12,500, giving me a total of 122,500. And current assets, I'm having inventory of 30,000, accounts receivable 22,500, bank is 40,000, cash is 17,500, giving me a total of 110,000. And here I'm going to be having, when I get to add this plus this, I'm going to be getting a total of 232,500. Then I come to the capital and liabilities, whereby capital for Abdul is 100,000, for Sarah it is 90,000, giving me a total here of 190,000. So I come to the current liabilities. Current accounts payable is 7,500, bills payable is 5,000, giving me here a total of 12,500. Non-current liabilities, I'm having Stanbic loan of 30,000, giving me a total of equity and liabilities as 232,500. So moving on, they're saying on 31st December, the partners agreed to admit Edith, and she paid 60,000. She is to share profits and losses in a ratio of 1:4. The assets were revalued as follows. So premises was revalued at 60,000, furniture revalued at 45,000, fixture and fittings revalued at 10,000, and then we had goodwill account revalued at 90,000. So they're saying prepare the assets account, goodwill account, capital account, bank account, valuation, and also the statement of financial position after admission of Edith. With this, I'm having a solution whereby I'm going to always begin with my assets that are being revalued. So going to the question, I'm saying that premises was revalued. So if premises was revalued, I'm going to get to know what was my opening balance. I know that premises is an asset, so it will have a normal debit balance brought down, which is 50,000 from the question here. Premises 50,000. Then what was it was revalued at 60,000, meaning that at the end it was revalued at 60,000. So my balance carried down will be 60,000. So I get to know which side is bigger. It is the credit side, meaning that I must find a balancing figure on the debit side, and the balancing figure on the debit side after getting the 60,000 minus the 50,000, my balancing figure would be a revaluation of 10,000, meaning that revaluation on this premises asset, this premises account, or the premises, is 10,000. So moving to the furniture, I get to know what was my furniture is also an asset. I get to know what was my balance brought down from the question. It was 40,000. I bring it here. Then what was my revaluation? It was revalued at 45,000, and I get to bring it here. So the balance, which side is bigger? It is the credit side. So I subtract this minus the 40 to give me 5,000 as my balancing figure, which I will call a revaluation. Then for fixtures and fittings account, I get to know that it's also having it's an asset and it's having a normal debit balance brought down. So I'm going to come and say the 12,000 here at the beginning is what I drop here, and it's being revalued at 10,000. So which is this here, 10,000. So balance carried down is 10,000. So I get to see which side is bigger. It is the debit side. So if it's the debit side, I'm going to subtract this minus this to get a balancing figure on the credit side, which is going to be 2,500, meaning that the revaluation is going to be on the credit side. Then after that, I go to another intangible asset, which is goodwill. And I know for goodwill, it was revalued at 90,000. So if it was revalued at 90,000, and I know that I'm having partners, Abdul and Sarah, and they're having ratios 1 to 4. For Abdul is having 1 to 4, and Sarah is having 3 to 4, meaning that the first one, this and this, is the old sharing ratio, and this is the new sharing ratio. So meaning that I'm going to get the one of Abdul, which is 1, and the one for Sarah, which is 3, divide by 4 when I add this and this. So it's going to be 1 out of 4 times 90, giving me 22,500. And for Sarah, it's going to be 3 out of 4 times 90, which is going to give me 67,500. So this side giving me a total of 90,000. So as a balancing figure, this side is going to be a balance carried down of 90,000. So also this side 90,000. So moving on to another asset, which is bank. So for bank, I'm also having a balance. I'm having a normal debit balance of 40,000, which is this 40,000. So after that, we get to know that Edith, she paid 60,000, yeah? And if she paid 60,000, we get to drop it here, the 60,000 she paid to the bank. Then after this, when I add this plus this, I'm going to get 100,000, meaning this side is bigger. So as the balancing figure, this side is going to be my balance carried down. So meaning that this is going to be 100 to give me to make these two balance. So after me knowing that, I go to my revaluation account. So for my revaluation account, I get to know which assets were revalued. I was having the premises. It was revalued. So since I'm having a debit side, this side, I'm going to have a corresponding credit side on the revaluation, and I get to know this is the corresponding credit side to complete double entry. And for furniture, since I'm having a revaluation on the debit side, then on the revaluation account, it will come on the credit side. And also for fixtures and fittings, since I'm having the revaluation on the credit side of the fixtures and fittings account, it's going to come on the debit side, which I have done. Then after doing that, I get to know that I first of all get to know which side is big, and I get to know that it's the credit side which is big. So the difference between the 15,000 minus the 2,500, it's going to give me a difference of 12,500. So it's this which I share to, I'm going to it's this that Abdul and Sarah are going to share. in order, like as a profit on revaluation, because remember, with the revaluation account, profit is recognized on the debit side. So the profit on revaluation, which is the 12,500, is going to be shared by Abdul and Sarah by their old sharing ratio, which is 1 and 3. So this one, 1 divided by 4, 3 divided by 4, so times the 12,500, giving me 3,125, and for Sarah is 9,375. So this one gives, when I add all this, it's going to give me a total of 15,000, and even this side give me a total of 15,000. So after me doing that, I'm going to go to my partnership capital account. So for this, I get to have my debit side and my credit side having details. Remember, it must show now Edith as our new partner, then Abdul, Sarah, Edith, then Abdul, Sarah, Edith. So after doing this, I get to know from my question. Remember, with capital account, it's having a normal credit balance. So I'm having Abdul having 100 and 100,000, and Sarah having 90,000, which I come and I drop here. Then their goodwill, the goodwill. So I go to the goodwill account. I get to know a goodwill account they were having. Abdul was having 22,500, which I drop here, and Sarah was having 67,500, which I drop here. Then the profit on remember, if it is a profit on revaluation on the partner's capital account, I get to put it on the credit side, which is this. So Abdul got 3,125, and Sarah got 9,375. So he brought in a capital contribution of 60,000, which he paid to the bank, and so I get to know which side is bigger. I get to realize that this side is going to be bigger. So when I add this, it's going to give me 125,625. Then this side is going to give me 166,875. Then for Edith, it's going to give me 60,000. So it's what I do this side to make it balance, and my balance carried down is going to be 125,625. Then for Sarah, it's going to be 166,875, and for Edith, it's going to be 60,000. And this is it, and my partner's capital account will be balanced. So after doing that, so next is the statement of financial position after admission of Edith, whereby I'm having Abdul. I get to give it a sweet title, Abdul, Sarah, and Edith's balance sheet as at 31st December 2020. So after doing that, I get to have my non-current assets or fixed assets, cost, accumulated depreciation, then net book value. So my non-current assets, remember, I go to the premises account. I had a balance carried down of 60, which I come and I put here. Motor vehicle, I never had the account, so it remains the same, 20,000, which I bring here. Then for furniture, the account was having 45,000, which I bring here. Fixtures and fittings, it was having a balance carried down of 10,000, which I bring here. They had no accumulated depreciation. And then my net book value, will be the same: 60,000, 20,000, 45,000, 10,000, giving me a total of 135,000. So my intangible asset is goodwill. I come and I search for goodwill. Balance carried down is 90,000. So I come and I drop the 90,000 here. So this plus this giving me a total of 225,000. So my current asset is going to be inventory from the question. Inventory from the question is 30,000. Accounts receivable is 22,500, which is this. Bank. Now for bank, I'm going to go to my bank account. Bank account, it's giving me a balance carried down of 100,000, which is this. So cash in hand from the question, it is 17,500, which is the same here, 17,500. So when I add all this, it's going to give me a total of 170,000. So when I add this plus the current assets, which is this, it's going to give me total assets of 395,000. So I'm having my equity and liabilities, whereby I'm having capital capital for Abdul, Sarah, and Edith as from the capital account here. I'm having Abdul having 125,625, which is this. Then Sarah is having 166,875, which is also this. Edith is having the 60,000. Then it gives me a total of 352,500. So with the current liabilities, I'm having accounts payable, which is 75,000 from the question still 75,000. Then bills payable, which is 5,000, still 5,000. Then the non-current assets, the non-current liabilities, which is Stanbic loan, 30,000, also 30,000. So the total equity and liabilities after adding this plus this, because this is a total, this is a total of this and this. So add this plus this, you're going to plus this, you're going to get the 395,000, which is equal to the total assets. So this and this, meaning that your balance sheet has balanced, and you'll be done with this question on revaluation. So that is all for today. Thank you so much for watching. Make sure you subscribe.